The first thing that typically happens if you're going into a recessionary environment is people tend to pull back on discretionary categories of spend. They move into the non-discretionary categories of spend. They pivot into food, they pivot into rent, those kind of payments, which are most important for them to meet. But the rails still stay the same. So the rails which run debit and credit are exactly the same. The technology is the same, the distribution model is the same. So those areas don't necessarily change by virtue of moving into more of a debit or credit environment.
One area that Mastercard has been moving vigorously into is B2B payments, a market expected to reach $25 trillion by the end of the decade.
We think there's tremendous promise in the B2B area. The card business, as in the elements of the B2B space which are served by cards, are doing well. They're doing very well. And it's in the small business space, it's the mid-market, it's in the large corporate space. All of them do really well. On the accounts payable side, I would say we're in the build phase. And here we're about building an open loop environment to enable payments on accounts payable rails.
Whereas the opportunity in that space is different to consumer payments, where there is a global standard. The global standard is Mastercard. The global standard are card payments because that's been established. That isn't quite established yet in B2B. And I think the more benefits we bring into the payments that are easier than just making a really complicated cross-border payment, I think we will find our way there. And we're going to see an explosion of creativity. A lot of other companies coming in and using those rails, innovating on top of them.
Pursuing new opportunities takes capital. Mastercard has spent billions acquiring companies that add capacity and diversify its infrastructure. Acquisitions and partnerships have helped Mastercard offer more value-added services to their clients, tapping into a lucrative revenue stream.
What we call services, which includes data, insights, consulting, managed services, loyalty, and our fraud capabilities, is roughly 35% of the revenues of this company.
Wow.
Yeah. So it's not insignificant. So oftentimes people think MasterCard and think card. Very important, but there's a very different part of MasterCard as well.
From a balance sheet perspective, Mastercard has maintained a healthy leverage ratio, even as it's put more resources into acquisitions and taken on more debt, giving the company flexibility to continue investing.
We don't go in and say, well, right now valuations are lower than they were a year ago, let's go and buy something. That is an opportunistic approach that doesn't work for us.
For me, it always starts, what are we trying to accomplish from a strategy standpoint? What are our inherent capabilities we as a company have? What are the gaps in our inherent capabilities to meet that strategy? And then for those gaps, is it best to build, buy, or partner?
And then we're out there and we're trying to find the right companies together, and it's going to make sure that we have a clear view on short and long-term synergies and so forth. And then we both talk to shareholders and to investors to explain what we're doing and why we're doing it and why it's good.